We're going to hear from the Fed tomorrow, and I've been doing some financial updates, and some of you seem to have an interest in that. We talked about the M2 money supply last week. I get a lot of emails about that because I think obviously people are worried about their own pocketbooks and their own life savings and how they're going to keep their head above water, and we're all feeling that. And now we're seeing what's going on in the banking system, and we keep being told by the same people who told us that inflation was transitory, we keep being told that the banking system is all just well, fine, and good.
It's solid.
As they're on their way to basically nationalizing the entire banking system. You're going to have J.P. Morgan. You're going to have, the big boys, Citibank, Bank of America, Wells Fargo, TD Bank to a lesser extent, basically going to control the large majority of deposits in this country, and they're all going to be under the thumb and indebted to the Fed and to the government. So we're effectively nationalizing the banks as we've gone from, I think in the early 1900s, about 31,000 banks to today around 4,000. And there's an article today in the Telegraph that says half of America's banks are potentially now insolvent. And this is how the credit crunch begins. And I think it already has begun for those paying attention. And it's very possibly going to get worse tomorrow as the Fed seemingly... Now remember, I couldn't have been more wrong about all of this because when they started to get off of zero, finally, a year too late, I never thought they'd even get into the... I don't think I ever thought they'd even get to 3. Well, we're about to go to 5 if he raises tomorrow, which seems utterly, almost calling for destruction on purpose. As people like Jeremy Siegel from the Wharton School said he should have stopped 400 basis points ago. We're going to get another 25 basis point hike seemingly tomorrow and even tighten up on these mid-tier banks even more. So there effectively will be no lending going on. No lending going on to businesses, to people. Mortgages are above 7% or whatever the hell they are. So you can't sell your house. You can't buy a house. So there's no movement there. There's no loans going on. And this Ambrose Pritchard in the Telegraph says the twin crashes in the U.S. commercial real estate and the U.S. bond market have collided with 9 trillion uninsured deposits in the American banking system. Just think about that. Such deposits can vanish in an afternoon in the cyber age. The second and third biggest bank failures in U.S. history have followed in quick succession. And I said this the other day, I feel like you almost hear nothing about it of any significant importance. He says the Treasury and the Federal Reserve would like you to believe that these 2 bank failures are idiosyncratic of each other, and that is a dangerous evasion of the truth. Almost half of America's 4,800 banks are already burning through their capital buffers. They may not have to mark all losses to market under U.S. accounting rules, but that does not make them solvent. Somebody will take those losses. Professor Amit Saru, a banking expert at Stanford University, said it's getting spooky. Thousands of banks, in my estimation, are underwater. Let's not pretend that this is just about Silicon Valley Bank and First Republic. A lot of the U.S. banking system is potentially insolvent. The full shock of monetary tightening by the Fed has yet to even hit. A great edifice of debt faces a refinancing cliff edge over the next 6 quarters. Only then will we learn whether the U.S. financial system can safely deflate the excess leverage induced by extreme monetary stimulus during the pandemic. A Hoover Institution report by Professor Saru and a group of banking experts calculates that more than 2,315 to be the exact number, U.S. banks are currently sitting on assets worth less than their liabilities. Think about that. That's half the banks. If we've got around 4,200, 4,800, 2,300 of them are sitting on assets that are worth less than their liabilities. The market value of their loan portfolios is $2 trillion lower than their stated book value. These lenders include some of the big beasts. One of the 10 most vulnerable banks is a globally systemic entity with assets over $1 trillion. 3 others are large banks. It's just not a problem for banks under $250 billion that didn't have to pass stress tests, he said. The U.S. Treasury and the Federal Deposit Insurance Company, the FDIC, thought they had stemmed the crisis by bailing out uninsured depositors of Silicon Valley Bank and Signature Bank with systemic risk exemptions after these lenders collapsed back in March. The White House balked at a blanket guarantee for all deposits because that would look like social welfare for the rich. Besides, the FDIC only has $127 billion of assets and less very soon, by the way, of that number, and may ultimately require its own bailout. So before I even go any further in this article, you can see the picture that this is painting. Yet, if you look at the charts for tomorrow, there's a 96% chance that the market is baking in another rate hike tomorrow because inflation is still sticky. And they can only see it maybe getting down to just a little bit above 3 before the end of the year. So I don't know if we were the first to talk about inflation, but we were probably pretty close. And at the time we said, you mix inflation with bad tax policy, and not only are you headed for recession, and even at the time I could not have dreamed that we could have raised 500 basis points in a year and 3-4 months. Never could have dreamed of that, given $31 trillion of fiscal operating debt. We are heading towards problems that I don't think some of us have, maybe since 2008, have even dreamed of seeing. Yeah. If we don't get a hold on this and the Fed doesn't show some restraint or tell us something tomorrow about what is going on.
And then, of course, couple that with Biden remarking yesterday that, let's be clear, he says all depositors are being protected. He said in remarks from the Rose Garden, shareholders are losing their investments, and critically, taxpayers, get ready for the whopper, are not the ones that are on the hook.
Right. Well, so then the 250 FDIC insured limit is basically meaningless anymore because it doesn't matter.